Q&A time from the market outlook from last year, because today is January 1st. And this one was 3 days ago, which was last year. I've taken two questions out that are kind of representative of like half a dozen questions on each one. The first one about my comment about living in a deflationary world, and another one about the packaging of Bitcoin onto balance sheets and into ETFs and into convertible bonds and into ETFs of convertible bonds. How I said that has the potential to destroy the global economic system, and why do I think that? And that was asked in a number of questions as well. So this first one here, what I have on the screen is the blue line. The erratic blue line is labor productivity. The red line, which you see in here, is personal consumption expenditure, the PCE. This is headline. This is a supply shock. This is the early 70s OPEC supply shock. This is the Iranian Revolution, another supply shock. This is the global pandemic. And I have a black line drawn at 5%. It is quite common with supply shocks that you get these peaks in inflation, more so than with demand-driven inflation. Very rare that you get these kind of peaks with demand-driven inflation. Usually when you see something like this, there is something in the supply that has caused that to happen. And then the green line is real GDP. This over here is the Cobb-Douglas production function. This is labor, this is capital. This is saying that output is a function of labor and capital. Here are two factors of production. And this is sort of suggesting that labor gets a certain amount of national income, capital gets a certain amount of national income, your return on capital, your return to labor, which is your wages. And A is total factor productivity. And this is a factor. This is factor 1, this is factor 2, and they have a certain amount of productivity. You can train labor over time. You can increase the quality of labor. And capital improves over time. It becomes more productive over time. So K is just the stock of capital. L is just the amount of labor hours available in the economy. So it's not capturing any of the quality, so it's always captured in the A factor, which is total factor productivity, whether it's productivity coming from labor, better trained labor, or productivity coming from capital. And this is also called the solo production function. And it is believed at the time that the A factor represented about 50% of the output, because the output, the level of output, could not be fully explained by increases in labor hours and increases in the stock of capital. So there was something else going on, which is called productivity, which the A captures. And at the time, and this was I think 56, 57, this paper was put out. So when we think about what productivity looked like and what real GDP looked like, you can see well above 10% on both the blue and the green line. We don't really have PCE showing up till the early 1960s. But if we look at where the blue lines are and where the green lines are, and where the red line is in relation to the 5%, what do we see? Other than the supply shocks in normal periods of time, what do we typically see punching up above the 5% line? Productivity, right? And right now it's sitting below the 5% line. And we had our supply shock here, and it's coming right back down. So why do I think we live in a deflationary world? If we look at the level of PCE over time, here it touched up against 5%. This was very, you could make the case late 60s, very demand driven. Here it touched up against 5% as well. That was demand driven. This was housing. Here's another housing shock over here where it touched up about 4%, not 5%. That was housing as well. And each regime, it tends to fall lower and lower. This is being referred to in academic literature as the great moderation. That rates, if you look at long-term yields, like the 10-year yield, the 30-year yield, they've been coming down over 30 years while inflation has been coming down. And it was right around the mid-80s and really the early 90s where technology really started to explode with the PC. It became more mainstream. It was still a small thing in the 80s. Not many households had them. But in the early 90s, more households had them, and with the advent of the internet, they're now everywhere. So the level of capital, when I say the level of capital, not the stock so much, but the productivity of the capital has really been increasing. To see the effect that has, what I'm going to do is I'm just going to see if I can take some stuff off the screen here, and we'll draw something out. And this will be capital to labor, and this will be output to labor. And typically, if you start with an economy with no capital, and you start adding capital, you'll get a curve that looks like this. So as you increase the amount of capital that labor has, so if you have 10 workers and you buy one tractor, you can do quite a bit of farm work. If you add another tractor to 10 people, you can do so much more. It's not just linear, it changes over time. But there comes a point where adding more capital to labor really doesn't do very much. So if we were here, for example, you would have sort of output here. Your tangent line here is your growth, is the rate of growth. And it looks like that. There's your tangent line. Now, this by the way, by adding more capital, that is called capital deepening. You're deepening the amount of capital you have. Now let's look at technological progress. What it does is it increases the line like this, so that for a certain amount of capital, if you had not just more capital but better capital, it pushes you up this way. So that's when you draw your tangent line here, although I didn't do it well enough, this is a higher growth rate. Now this, because you're on a steeper part of the curve, you end up with a higher growth rate than you had before. So if you have a higher growth rate, I'm walking you through a couple of steps here. Let's say that you have a growth rate here, and let's say it's 2%. And you have your GDP growth that you're measuring over time that kind of looks like this, right? Well, all of these, this is demand-driven. We're assuming demand-driven inflation, because once you have supply-driven inflation, you could pretty much throw everything out. Supply-driven inflation is its own enemy. But when we talk about inflationary pressure in an economy where the interest rate, raising the interest rate to tamp down demand, usually we're talking about demand-driven inflation. Well, you're going to have inflationary pressure show up here. You're going to have inflationary pressure show up here and show up here because the economy is producing above its capacity. So if you have an economy at capacity and costs increase 4%, if you're pretty much at capacity, output would increase 0%, which means nominal GDP would be, in a naive way, 4%, while real GDP would be 0%. Inflation is 4%. But if you have, if you're moving from one curve to another curve because of technological advancement, you actually have, let's say you could move it to 3% is your potential GDP. Notice you do not have inflationary pressure here any longer. Because you are operating below capacity. So there's always room to add more capacity. So as costs increase, your productivity can increase and produce more output because you're not at capacity. So you no longer have that inflationary pressure. So moving upwards, technological advance allows you to increase your potential GDP, whereas before you may have had inflationary pressure showing up early. Now you don't have that inflationary pressure showing up. So if you have technology that you feel is probably going to continue and I wouldn't say accelerate, but certainly find its way into more and more parts of your life, more and more parts of the workforce, more robotics, more AI, things like that. You could expect this curve, and this curve, if you can continue with technological progress, you should be able to continue with growth rather than hitting what is called the stable state. You should be able to continue growth. If you move it up to 4%, let's say, then you can increase output before you even hit inflationary pressure. So you can have higher real GDP growth if you have higher potential GDP before you hit inflationary pressure. Well, technology does this. It pushes these lines up. So that is what I mean by we live in a deflationary world. As soon as you have technology in play, which increases productivity, that decreases unit costs. It could decrease it to a negative point. That's deflationary. Now, combine that with some countries that are aging and their populations are shrinking, Japan, China, and you will get deflation. There is no other alternative but to get deflation, because you don't even need technological progress at that point if you have a shrinking population. Because what will happen is the economy will start producing below and below and below its capacity. So you can even have a technological reversal with a shrinking population and still get deflation. You don't need technological advance at that point. So hopefully that gives you sort of a nice picture of why I think we live in a deflationary world, if you believe that technology will still continue. Okay, this next one also was asked quite a few times, but not in the same way. It was just saying how can Bitcoin blowing up destroy so much? Not if it blows up now. If it blows up now, some people will lose money, but not too much bad would happen. If convertible debt arbs are delta hedged, how does the implosion play out? Well, they're delta hedged on the way up, right? They become more delta hedged on the way up. Well, I shouldn't say more delta hedged. They're delta hedged all the time. It's just the delta increases towards 1 on the way up, so they're more likely to be fully hedged the higher the price goes, and less fully hedged the lower the price goes. Or is it the hedged participants that get wrecked when the converts fall way out of the money due to the value of the collateral falling? So what we have is you have this thing, Bitcoin, is now showing up on more and more balance sheets, which puts the stock of those companies at risk. We have Bitcoin that is wrapped in ETFs now, and then you have options on those ETFs. Where you're getting Bitcoin on balance sheets, these are being funded by convertible bonds, and there is an effort now to package these convertible bonds into ETFs and structured products. When Wall Street gets a hold of a toy, and this is the toy right here, and these companies have at the market offerings, so there's fees. That's where the money is. You have volatility, which that's the fuel of Wall Street, is volatility, because they're the casino, they're not the player. Now, volatility means more fees, means wider spreads, means more trading, right? That's gold for Wall Street. They will milk that to death. So if they see convertible bonds being placed, Bitcoin being placed on balance sheets, then it's a matter of, well, how many other companies does this make sense for? You're seeing it show up in the Bitcoin miners right now, because that seems like the logical place to go. Let's take supply off the market by making sure that the new supply being minted does not hit the market, such that you get even more volatility because you're reducing the free float of what's out there. Now, just imagine they keep doing this. They keep introducing new ETFs, specialty ETFs, structured products of structured products, structured products of ETFs, and on and on and on. They will package and repackage this. That's the danger. Because now it's not just going to sit with Bitcoin, it's going to sit in a small group of people. In the small in terms of the percentage of the population. There might have been 3 or 4% of the population that would have played in that space. if there were no ETFs or any stock through which you can play it on. But now you introduce ETFs, and what was it? The fastest to $1 billion of any ETF ever, IBIT, and growing. You have it on balance sheets as part of a treasury model. Now we're not going to sit in cash and cash equivalents. Now we're going to sit in Bitcoin and hold the Bitcoin. You have convertible bonds, and that issuance is increasing as well. This is the problem, because it starts to appear everywhere. This is going to appear in taxable accounts, and you can buy Bitcoin miners in your RSP, in your IRA. ETFs allow people to have access to Bitcoin who otherwise wouldn't have jumped through all the hoops of getting a crypto exchange and sending their money into there to hold Bitcoin in a wallet. Some people don't want to do that, right? You have hedge funds that can get into the game with the convertible bond. These are not bond funds, by the way. Convertible bond is considered a form of equity, and since you have to use it in combination with equity, it's not bond funds that are really holding this. And the more you can package it, the more you can allow other holders who would have some kind of IPS restriction to suddenly start holding these. So there could be a type of fund out there that says, well, we can't hold this kind of stuff unless it looks like this. Well, it won't take Wall Street long to package it into something like this. If we look at the size of the crypto token space plus Bitcoin, it's about $4.5 to $5 billion right now. If you look at BITW, which is an index, this is the index of the top 10 cryptos, that's at $3.5 trillion. As this continues to grow, and as it finds its way into more and more balance sheets and more products, remember now, Bitcoin works the same way at $100 as it does at $1 million. The blockchain would continue to work. The miners, the mining function would continue to work. A block would be added every 10 minutes, and new Bitcoin would hit the market every 10 minutes, no matter what the price is. Price can drop to $1 a Bitcoin, and you'll still have a block added every 10 minutes and new Bitcoin hitting the market every 10 minutes. So that doesn't slow down. It works the same way at $100 as it does at $1 million. So there's nothing stopping it from hitting $100. It's not the marginal cost. If we look at gold miners, this is the typical shape of an all-in sustaining cost curve for gold miners, and they are positioned along this curve. So if the price of gold dropped to here, these miners no longer mine gold. If the price dropped to here, your supply equals zero at that point, because the price of gold is below everybody's marginal cost. When it comes to Bitcoin, marginal cost follows the price. So if the price of Bitcoin drops, some miners would just stop mining. The difficulty adjustment would adjust so that you'd still have a block every 10 minutes and you'd use less electricity. So that would lower your marginal cost. If Bitcoin dropped even more, you'd have some more miners drop off. The difficulty adjustment would adjust such that every block still takes 10 minutes and you'd use less electricity to mine it, because the solution would become easier and easier, so marginal cost would come down. Because of that, because there is no economic backstop to the price dropping. With the price drops, the marginal cost will adjust. Not with gold. If the price drops, that's it. That's it. So the price is a mechanism by which you can allocate resources, not for Bitcoin. So this has the very real possibility of blowing up, because there is nothing backstopping the price of Bitcoin. There is nothing. And the idea that, well, it's all the energy that's in it, that does not mean that it has to hold that price. If I spend $1 million writing code, could I then say, well, I've turned code into dollars? My code is worth $1 million. Not if it doesn't do anything. Not if somebody won't give you $1 million for it. There's lots of cases in history where businesses have spent a lot of money to produce something and got nothing out of it, and it becomes worthless. Not because the money wasn't spent, but because nobody wants to pay for it. So you can have all this electricity show up in Bitcoin and the market say, I don't care. You wouldn't be the first person to waste money on developing something. So that's not an argument. It's not an argument at all. So this is the problem. is unless it gains real market traction before the larger private companies decide that, okay, it's time for us to move in. You've proven the market, which has been the history of this kind of technology before. Not this kind of technology, but whenever you have a lot of players in a new technology, usually the big players stand back and wait for the small ones to prove the market, and then they step in and do it themselves. I see the future being permissioned, not permissionless. And if it's permissioned, you don't need a native currency on the blockchain. You don't need a native currency, which means all those cryptos, all this Bitcoin is no longer needed. It is permissioned. You have all the benefits of your trusted third party and all the benefits of the blockchain all at one time without the need for this native currency. It's only a matter of time before we get there. But I think before we get there, we have a squeeze up. And then I think it ends very, very badly for everyone in this channel. Okay, let's go through the longer Q&A here. In the Q&A, can you do a retrospective of the predictions you made last year for 2024 and what actually happened? That would be a lot of work, because if you go through the market outlook for 52 weeks and then starting in September, the positions videos, I make a lot of bets. I'm doing this, I'm doing that. And sometimes, for instance, the beginning of 2024, I thought ZQ was pricing in way too many rate cuts. It was pricing in 7 to 8 rate cuts. I thought that was stupid. So being short ZQ tended to make a lot of sense. But by the end of the year, ZQ was only pricing in 1 to 2 rate cuts for 2025. So being long tends to make a lot of sense. TLT. When it pushed up against $100 earlier this year, I said, I don't think that's the right number. I was selling calls at 101, 102, because I just didn't think that was the right place to be. And then where are we now? $88, and I think that is the wrong place to be as well. So it's to say, can you do a retrospective of what predictions I made and how they worked out. It would just take too long to do. It would take me days to go through everything to figure it out. Let's talk about some of the things that did not work out. The big one was being short beta using SPY. When you are short, you have to be tactical. Tactical means that if your short position is moving against you, you got to step in and use the options very quickly to hedge out as much exposure as you can, or shut your position down. This position was a lot of work. It was a lot of work. Sometimes on a daily basis, you had to work that position, and I was short beta so that I could be long beta somewhere else that hopefully would have outperformed, and that is where you get alpha. So you short to go long. That's called a long extension. Wrong target. I should have used IWM the whole time. When I switched in the fall, I switched from being short beta using SPY to being short beta IWM. That has worked out absolutely fantastic, and I will continue to use IWM to get my short beta. TLT, I didn't expect it to end the year under $90 at $88. I didn't expect that. I thought mid 90s, mid to high 95 to 97 to me is a good range for TLT. I didn't expect it to be here. I didn't expect this huge bear steepening once rates started to get cut. That was unanticipated, so that didn't work out as well as I liked. And then a couple of stocks that I bought along the way. Bell did not work out very well. It had the characteristics of a value stock. It had what looked like to be in place a plan, but I just didn't pay enough attention to management. Management made some boneheaded decisions in there, and I was in around 46. I think I bailed 38, around 38. Where are we now? 33. I think they're going to have to cut the dividend. Goodyear Tire, yeah, that fell all the way down to the $8 range. I played the options for as much as I could, and then it was finally called away from me. I think I took a loss on that one, but it was far less than the loss I would have taken when it fell. I should have done more research on Goodyear Tire. For the ones that I did get in trouble with, I'd say it's probably because I didn't stay with them long enough before I took a position. So I should have dated them for a while before marrying them. With Bell and Goodyear, I just jumped right into the marriage without dating them for any period of time. That did not work out well. I'd say the worst performer for my year was Bell. I'm sorry I ever met this guy. And then the short beta. But again, I have to think, well, if I didn't short beta, I probably wouldn't have taken some of the long positions that I did take. So if I think, well, what positions did you take that you were short? Your gains here should balance against your losses here. But when I switched, I really made it back, especially in the later part of the year. Short IWM up in 240s, 238, 240, 241, all the way down to, where do we get to? 219, 218 we had a print. Covered there, covered some there. I'm still short on IWM, and I'll remain short on that until things change. As far as my biggest winner this year was Capri, because I really loaded up on that one. It was sitting around $42, $43 midsummer, and I felt that was just the wrong place to be with rates being cut, and I took a large position in this along with a whole bunch of puts. I was selling puts at 48, 47, 46, and this ran to 56. And I lowered my position from 64,000 down to 22,000, and I kept saying, I really hope it goes back to this level so I can do it again, because this was the second time I had done exactly this. And sure enough, where are we now? We're back at 42. So I think I'm somewhere around 38,000 shares right now. I'd bring that up to 100. The longer it stays down here, I'm just going to keep adding till I get to about, till I get to 100. It may move before I get there, but I'm willing to go up to 100,000 shares this time. That was beautiful. That played out over a period, I think, of 2.5 months. It was a nice return, and I had it everywhere. I had it in my taxable account, TFSA. When I say taxable account, I mean outside of any registered account. I had it in Liras, RSP. I had it everywhere. What are the implications of such a large term premium? Well, if we attributed to the term premium, I don't know if I would say, what are the implications? I don't think it really matters that we say, okay, well, the term premium is very high. In the end, the yield is high, and it is the capital market curve off of which most consumer debt is priced, not the money market. So if we're looking at financial conditions getting looser or tighter, as far as the consumer is concerned, they've gotten tighter since the Fed started cutting because the capital market curve has been elevated. So the implication is just higher yields and more restrictive monetary policy for the consumer, which makes up the largest part of the economy. So at this point, if the market is going to price the capital market curve higher, the Fed could cut rates tomorrow 100 basis points. And it wouldn't change much for the consumer. I'm not going to say it wouldn't change nothing, but it wouldn't change much for the consumer because most of their debt is priced off the capital curve. My portfolio returned 53% this year. Show off. Number I thought to be unimaginable just a year ago. Looking forward to some volatility in 2025. Diving 10Ks, 10Qs, news presentation. Feel like there's something missing to take it to the next level. How do you approach analyzing a company or deciding to invest, especially between earnings? For example, why are you moving back into cybersecurity stocks now? Well, because they're pulling back in price. I had taken some positions in some of these stocks, and I had a number in my head that I thought made sense. But this market wants to get everywhere immediately. If the market agrees that a $100 stock in 2 years will be a $200 stock, the market says, well, why wait 2 years? Let's get there in 2 weeks. So once it hits your price target, you're thinking, well, here we are. So you lighten up, or you exit your position saying, well, I made that. Now they're pulling back. So most of the time, if you're moving in and out, it's not because your opinion of the company has changed. It's because the valuation of the company has changed. So I still think cybersecurity is going to be a big deal going forward, especially with AI. AI can help bad actors write malware much faster, which means you're going to need more protection going forward, not less. But at some point, even though it's a good sector and a good business model and good companies, the valuation doesn't make any sense. But when the price pulls back, it's like, okay, well, now at this price I'll buy. But it wasn't as if my thesis had changed, just the valuation had changed. Any free resources you'd recommend for staying on top of company news, aside from news section on the website? That's the best one. Wall Street Journal is good. Barron's is good. I think they have a promotion on right now where for your first year, it's $4 a month, and you'll get Wall Street Journal, you'll get Barron's, and you'll get Market Watch. Although I don't find much value with Market Watch. Barron's it's okay. It's okay. Wall Street Journal, I think, is the better one. Not as good as it used to be years ago, but given that we live in a digital world, you don't rely on Wall Street Journal that much for all your news. Same with Barron's. Those used to be the two kings. But if you have Bloomberg on, you pretty much hear everything all day long anyways. That the next morning when you open up Wall Street Journal, it's like, well, I've heard all this. There's only a couple of stories you care to read. The opinion stuff is not bad, but overall, I'd say every day in Wall Street Journal might be 3 or 4 pieces I read, and that's it. Barron's, 1 or 2. I don't find a lot of value in Barron's anymore. I don't know if they're ever going to fix that. Other than the company website itself, not really. Things don't change much between quarter to quarter. You're not going to get a business that completely changes its business model. So if you're looking at the last 5, 6, 7 quarters, usually momentum will carry it in the same direction. But you do have management in there, and management sometimes can make boneheaded decisions. So, answering the question, I don't know that there is one method where I would say, here you go. The more companies in a sector, the more likely you are to have more of a mosaic, which means one company says something and you read something about that industry from the industry association, another company says something, and you could say, I see a trend happening. It must also be happening to this other company, even though they've said nothing about it. This is work, right? It is work. If you don't put in any work, then this is gambling. Let's see. Market's position here. As an investor, if I'm bearish on term premium, let's assume due to inflationary expectations, but bullish on overall corporate health in the short term, credit spreads, wouldn't high yield spreads outperform treasuries in this case? And that's what is possibly happening. Well, the return on CCC this year has been the decrease in the spread. We started the year at 1,000 basis points, ended the year at 750, and high yield tends to be oftentimes less than 10 years from issuance to maturity. 5 years is quite common So yeah, that it was the contraction in the spread that produced that performance. It wasn't in the yields. It was a contraction in the spread, most definitely. You're predicting a favorable climate for investment banking. Are you therefore long XLF? Well, XLF has a whole bunch of banks in there, including investment banks. I think you can do better than XLF and just isolate it to investment banks. If the interest in high yield Is the interest in high yield a reflection of soft landing expectations in a booming economy? Probably. Or perhaps it's a reflection of a realized soft landing. Yeah. Eagerly waiting for your video on miners. Had a question though, went through sites, 10K for some of them. Doesn't look like huge infrastructure build. Some of their mining sites look like trailers. Most of these miners have less than 500 total employees. Well, with mining operations, you don't need a lot of staff. You just don't. Compared to data centers for companies like Tesla, Amazon, Microsoft, Facebook, Apple, and many others are huge in scale compared to these miners. Yeah. Can you comment on what's holding one of these to invest some money and start mining? Can you comment on what's holding one of these to invest some money and start mining? I don't understand that sentence. Do you mean like Tesla, Amazon, Microsoft? What's stopping them from doing it? Why would they? I mean, I seem to think that would be saying, how come Microsoft is not opening retail stores and selling jeans? Walmart does, Target does, and they make money at it. Why is Microsoft not doing it? I mean, they have the money to. It would, to me, that to ask why Microsoft is not getting into Bitcoin mining is pretty much the same thing as saying, why aren't they selling jeans in retail stores? It's not their business. It's not their business at all. Why would they do it? I don't understand why they would do it. The Bitcoin miners, Bitcoin mining is not profitable at all. So when I put the video out for understanding Bitcoin miners, you'll see that they're just not profitable, and that's because of the economics of Bitcoin. That it's and the game theoretical aspect of Bitcoin mining is such that the higher the price goes, the more suboptimal the equilibrium becomes, the worse it becomes for everybody as the price goes higher. The Bitcoin miners have to generate revenue from other sources. So they may get into data center hosting, for example, because they have the infrastructure for it, or they have the power purchase agreement in place. They may set up their energy operations to be either behind or in front of the meter, which means that they may be able to earn credits or actually generate revenue by selling their lower supply of power back to the grid when power needs spike. So they can do that. But you could be an Enron type power broker, and that's what Enron was doing. It was buying huge amounts of power from power producers and then being an energy broker and selling it back into the market. So there's that aspect of the business to try to manage your costs down. So they have to find other ways to attempt to make money. And the way they're doing it now is saying, well, rather than selling our Bitcoin to pay for our operations, what if we held the Bitcoin on our balance sheet? And if we look over a period of time and look at the Bitcoin price, it's hugely volatile. But if we didn't sell our Bitcoin here but sold it here, we would now also have a capital gain on top of our income, right? But how do we pay our expenses? Well, we can use convertible debt and pay no interest on the convertible debt. And if the share price goes up, this converts to shares, which is not an issue, because many of these companies, the miners, were just issuing shares like crazy to fund operations because they are not profitable. So why the hell would Tesla, Amazon, Microsoft ever want to get involved in a business that they're not involved in? I would say I would not look for them to do it. Where I would look for someone to get involved in Bitcoin mining, where it would more than likely happen, is an energy producer with excess capacity. And let's say it's a wind farm. They have a whole bunch of these wind farms, right? And it's generating a lot of wind, but they have no battery storage, so they simply just use it. Well, you can turn that electricity into Bitcoin, and then you can turn that Bitcoin into dollars, right? Even if you lose a little bit of money on the transfer, you would have lost all of it from here. So that is a more likely outcome to if you're an energy producer and you're saying, well, let's just build a big wind farm. Who are your customers going to be? Well, the customers will show up. In the meantime, we'll do this, because you can start a Bitcoin mining operation rather quickly. I would say that would be the biggest threat of competition to the miners, is the energy producers just saying, well, why do we need to find a Bitcoin miner? Let's just do it ourselves. What do you think the solutions to economies that are experiencing Japaneseification, is that a word? Japaneseification, such as Japan. It's a good thing you said such as Japan, because I wouldn't have known what country you were referring to with that. And economies that will likely fall into that, such as Euro and China. What do you think solutions are? That's a tough one, because if you have populations that are shrinking, you're going to have to start to measure GDP in a new way. You can't keep saying we need to get GDP higher and higher. You're going to have to start thinking in terms of GDP per capita and finding a way to reduce capacity in the economy by letting industries fail. I mean, that's the only thing you can really do. The more you keep industries alive to try to protect jobs with a shrinking population, the more you're going to get deflation, because these zombie companies will keep pushing supply onto the market, which hurts everybody. China, I don't think has a choice. I think deflation is their future, because they're not completely market based. They're not going to move fast enough. I don't see China as having any choice in their future right now. As you mentioned, volatility is the theme for 2025. Would you ever consider trading VIX? No, I would not, because VIX is not a no arbitrage target. So if we look at VIX, VIX is sentiment driven. So let's say you're looking over time, January, February, March, and everyone's expecting, let's say that the VIX curve looks like this, and everyone's expecting volatility. It will do this, right? It'll do that. If you think about it in terms of gold, let's say, and you were looking at gold futures instead of VIX futures, January, February, March, and it looked like this, and somebody said, or the market says, we think prices will go much higher, the curve will still look like this, because it's based on no arbitrage. So if the spot price over here doesn't increase, there's no reason for the curve to increase. But if we're thinking, well, gold will be $3,000 an ounce by mid-2025, if the spot price is still $2,600, the curve will not change at all. Because if it does change, it opens up an arbitrage opportunity, because the futures price over here is a function, future time t, and let's call this time t, is a function of the spot price today, and we're going to use continuous compounding. I guess we're not using LIBOR anymore. We don't have to use continuous compounding. 1 plus R. R would be whatever your risk-free rate is up until that period of t, whatever your spot rate is. It's an interbank rate. And we're just going to go ahead and we're going to subtract Q off of that. Q is the yield, or you could say the cost of carry expressed as a yield. The cost of carry expressed as a yield, and then T expressed in years. So if it's 3 months, it would be 0.25. So that's how you get to a futures price. So if you say, well, the price will be $3,000, but the spot price hasn't changed, well, your forecast isn't going to change either of these two things. So the futures curve wouldn't change. But for VIX, if you say, oh, we expect VIX to be higher, it will start pricing higher, which means you are not making a bet on the when you're looking at VIX saying I think volatility will be higher, I'll use VIX futures. You're not making a bet on the level of volatility. You are making a bet on the difference in the level of volatility that you think will happen versus what the market has already said would happen. So if the market expects volatility to be high and you look at the March contract for volatility, it will already be high, in which case you're making a bet on the market being right or the market being wrong at that point in the future, as opposed to some no arbitrage situation today. It doesn't have that feature. So you're always betting either that sentiment is not strong enough or sentiment is too weak, as opposed to saying some fundamental value is too low or too high. That's why I'd never play the VIX. I've been through your applied options portfolio construction course, both being helpful. A suggestion, applied options, love to see if you also include common setups. Like it could be that you're taking a volatility play because you believe volatility is too high. I want to know how you assess this particular factor. As in, I know what to do when there's a change in volatility or the underlying price, but the problem still remains of forming an opinion on it. That's not a science. There's no chart I can give you with if-then statements. It is experience, it's education, it's intuition. So, there is science and there is art, right? The combination of science and art is called a craft. Investing is more like a craft. There is some science behind it, meaning that there is some a level of understanding you need of the relationship between variables, understanding that these relationships are generally always probabilistic. Sometimes you have very high correlations in relationships, sometimes low correlations, sometimes changing correlations. And then there's the art part of it, which comes with experience, intuition. Intuition is gut feel. So it is the combination of the two. You can teach this, but you must develop this. There's not much I can do on that side. It's something that you sort of have to develop on your own. It's just experience over time. Did you see the 03 release? I don't know what the hell that is. It seems like a fairly big leap forward in the sense that it shows that you can use additional compute at inference time to get the same results as training the model for longer. Oh, I see. To me, that opens the door for treating better models as an OPEX expense rather than CAPEX expense, and probably has revenue implications. Okay, so it just depends on what statement you're putting it on. If you put it on the balance sheet, you're amortizing it over time, or you just put it right on the income statement. I don't know that the implication would be that large. I don't know how to answer that one. I don't know. You mentioned you already explained how to play volatility. Could you provide the link where you explained how to do so? That is in the positions videos in the applied level section about fertilizers on the sector studies. Yeah, I can do that in time. I'm not going to say I'm going to get to it right away, but in time I can do it. I'm trying to sort of get to some exciting sectors. So we finished cybersecurity, which I think will be interesting. I think with the advent of a lot of these convertible bonds showing up there, I think the Bitcoin, the crypto sector is going to be interesting only for a while. So it's not as if crypto is going to be what I would seem to think is, a 10-year industry, right? I think it's a fad that will have its time, and then it will disappear, and whatever value there is in a blockchain approach to something will be predominantly permissioned with no native currency required. And if there is going to be digital currency that is widely embraced and accepted, it is going to be a central bank digital currency. The idea that any single government will allow its monetary policy to lose effectiveness because this crypto is just going to take over the world is fantasy. It's pure fantasy. And if you are of that thinking that this is going to replace everything, you need to check your enthusiasm, because that's simply not going to happen. Long-term treasury yields to rise as much as they have since early December would require some major asset managers to liquidate those assets. Well, the Fed is one. The Fed is one that has been running off its balance sheet still. I don't necessarily know that it's one way that we can look at that is to come up with a counter argument in which you don't have selling. I don't know that you need liquidity to reprice an asset. The market could reprice the bid and the ask without any liquidity in place. This happens very often on announcements of significant news. A currency will reprice almost immediately with almost no volume, causing that repricing. Same with just the bid and the asks change. The market participants just change the bids and the offers. Same thing with stocks after hours. When you see it gap up, $8-9 a share, it gaps up. There is no volume in that gap. So I don't necessarily know that you need any volume to have the market change its perception of value. Could you talk a bit where you think money being liquidated from treasuries is being directed? Well, I don't know that money is being liquidated from treasuries. Any seller of a treasury, there's a buyer of a treasury. So, I guess the question you could ask it from the other side is, as these people are selling their treasuries, where's the money coming from for the people who are buying them? You can say, where's the money going to, but where's the money coming from? I don't know that there's an easy answer for that. I don't know if there's an answer that's clear. Coming from all sorts of places, going to all sorts of places. Which videos do I have to watch to understand how you're reading what the market is pricing in for the Fed's rate cuts? You don't need to watch anything. You just have to go to CME and look for STIR analytics. That's short-term interest rates. You'll get a thing that looks like this and a side menu that looks like this. There's one over here that says FFF. Click on that one and you'll get the Fed Funds Futures curve. Possible there will be a fundamental shift in how we evaluate markets. Well, unless you tell me what you're thinking, I'm more apt to say probably not. With increasing number of opinions in traditional and social media, market movements will primarily become a narrative-based instead of fundamentals. Well, narrative-based pricing has been with us for some time. That's usually, small caps. It's more about the story you can tell than about what the fundamentals show. The .com was purely all narrative. I don't know that this is a new thing. I think crypto right now is pure narrative. I don't know that you could find much intrinsic value there at all. And when I say no intrinsic value, there's no intrinsic value in the output. That doesn't mean that money hasn't been spent in arriving at the output. Again, I can build an airplane that doesn't fly, and I've spent a lot of money building that airplane. That doesn't mean the airplane has any value. The output could still be worth zero, even though you spent money. Sure, money is being spent in electricity and all sorts of things to produce a stream of zeros and ones, but that's not a logical reason why the zeros and ones should have value, because money has been spent. Money's been spent on a lot of things that end up having zero value. So I don't accept that. That's purely narrative, because you need a story. And unfortunately, that story relies on a lot of misinformation, with Michael Saylor probably being the king of that misinformation. Now, I don't know if he's stepping over any boundaries, but it would not surprise me one bit in a couple of years when this falls apart if he's under investigation for something. Wouldn't surprise me a bit. From where I stand right now, I don't know what you'd investigate him for, but if you listen to any of his presentations, the stuff he says easily demonstrated to be false, and I can only believe that he's smart enough to know that what he's saying is not true. He's truly misinforming. So that's all narrative driven. Tesla is being narrative driven as well, but this is not new. I mean, again, the whole dot-com bubble was narrative driven. When calculating the term premium, why do you square the 2-year rate for comparison? Because all rates everywhere are quoted annually. So when you see a 3-month rate, that's quoted annually. So you would take 1 plus the 3-month. You divide that by 4 if we're talking SOFR now, and then 1 plus the 3-month forward, right, divided by 4, and you do that all the way to the 8th month, or you just take the 2-year, 1 plus the 2-year yield, and you'd square it, because this is an annual rate and you're looking for 2 years, right? So if you had $1, how much would that grow in 2 years? And if you had $1 here and you rolled it over, how much would that grow in 2 years? Since the 2-year is equal to the current 3-month, 4.31, and you have a downward sloping forward curve, you must have a term premium. I get confused every time yield and credit spreads are discussed. Are there any videos? Okay, so a yield is the sum of the credit spread and the risk-free rate, right? So if we think about, well, I'm just going to draw out something very naively. Let's say that is the PAR curve, the government PAR curve, and you look at a particular, let's say, A category of bonds, A bonds, and you find 1 year, 2 year, 3 year, 4 year bonds, and you map out where those yields are. That would be the yield curve for A. The difference between this is the credit spread, and the difference between here and here is the risk-free component. So the yield on any corporate bond is a function of whatever the risk-free rate is plus the credit spread. Have you went through CAI's curriculum? No, I have not. If the 3-month and 2-year forward rates both converge at 431, well, they're not forward rates. They're the 2-year is a yield. The 3-month is a spot rate. They're not forward rates. They converge at 431. How should we interpret this in terms of market expectations? Well, nothing in terms of market expectations. If we look at the forward curve for 3-month SOFR, we see that it is downward sloping. You would interpret that as far as expectations to mean that the market is expecting lower 3-month rate. Does this flattening of rates suggest that the term premium is diminishing? No, that it's increasing, Could it signal a shift in investor perception about short-term versus long-term risk? I don't know what that means. What do you mean? Well, I'd first say, well, what do you mean by risk? What risk are you talking about? What do you mean short-term? And what do you mean long-term? What do you mean a shift? Like that, your question does not give me some idea of what you mean by these words. How does this tie into broader arbitrage dynamics? Well, what do you mean by that? Where locking in a shorter term rate might lose its relative advantage compared to... I have no idea what you mean by these questions. Locking in a shorter term rate. How do you lock in a shorter term rate versus a longer term rate? I don't get that. You'd have to keep rolling over the short term rate. I don't understand what you're asking. Also, given Trump's remarks about penalizing nations that devalue the US dollar, don't know that he said that they were devaluing the US dollar, but that they wanted to leave the US dollar. Increasing discussions about a BRICS-backed currency, what would be the realistic implications? Who the hell knows what the realistic, theoretical implications? If such a currency were launched, who the hell knows? I don't know. All you could come up with are scenarios and theories and hypotheses. There's no realistic implications to that. It's like, ask 10 people, you'll get 10 opinions. None of them will be wrong. Only time will tell which one plays out. Considering the economic stature of Brazil, Russia, India, China, South Africa, how might this development influence U.S. markets? I don't know. Particularly in terms of capital flows. Who the hell knows? Reserve currency status to who the hell knows? All you could do is come up with theories, hypotheses, possible scenarios. But all of those will just be guesses. We live in a strategic world that if you do something, I can't just say, well, if you do something, here's what's going to happen. You can't do this until you say, well, what's the other person going to do if you do that? Right? So, who knows? Who knows? These things are, they may be fun to discuss in a theoretical way, but certainly not the basis of allocating capital. Not this early in the process, especially not when it's being done. And what effect will it have? I would say that it would range from zero effect to really affecting a lot. And somewhere within that range is where you'll be. That's about the best you can do. My understanding was that Bitcoin was increasingly expensive to mine the more Bitcoin was mined. Nope. Bitcoin is more expensive to mine the higher the price. As the price goes up, the cost of mining it goes up. As the price goes down, the cost of mining it would drop. It would have to drop because some miners would just say it's not worth me doing anymore. So no, it has nothing to do with the supply that is left. It has nothing to do with that. If the cost of mining is a function of the value of Bitcoin, yes, it is. How do you think about the financialization of Bitcoin? I don't know what that means, financialization of Bitcoin, and its potential to be used as collateral or loaned out. Does it have potential to be used as collateral and loaned out? Why would you want to borrow it? I mean, other than to short it, I'm not sure why you would want to borrow it. My thought is that many investors will be hesitant to sell their Bitcoin for fiat because they don't want to pay taxes, and they may not want to enter the financial system and deal with know your client, anti-money laundering issues. I could see a situation where they might sell BTC for Tether, loan it out, or loan against it to draw out some cash. You could also see a situation where MicroStrategy or other large Bitcoin holders monetize their BTC holdings to generate cash flow via loans. Once you start lending, you increase the supply. So if if the Bitcoin community thinks there'll be a vibrant lending market, then they can't keep pounding us over the head with limited supply, man, limited supply. Once you start lending, that limited supply is gone. You don't even need fractional reserve lending to get that done. Once you have fractional reserve, then the supply of that currency will increase, period. So if the true meaning of this is to be fixed, if that is the spirit, the philosophy of this, then the whole community should be dead set against lending, should be absolutely dead set against lending. If the true spirit and philosophy is to be decentralized, the whole community should be against governments and private organizations hoarding the supply, should be against it, but they're not. So that tells me that they're not really invested in this limited supply thing if they're also going to embrace lending. That they're really trying to be just like the US dollar and have monetary policy just like the US dollar. In which case, just use the US dollar. Once you start with the centralization of the currency in the hands of government and private enterprise, once you start with lending, aren't you kind of trying to be the US dollar at that point? In which case, what do you need Bitcoin for? I mean, either it's going to be this limited supply of something that is decentralized and not controlled, and the money supply can't be manipulated by fractional reserve lending. Either it's going to be that and have some use case because of those features. But if you're going to say, let's make all the features of Bitcoin the same as the US dollar, then what the hell do you need all these imaginary zeros and ones for? Just use currency. It seems like a lot of gymnastics just to make it work. I had a discussion the other night about how would you include crypto in your business? Oh, well, I guess you could do this and you could do that and I guess you could do this, but all of it was twisting things up just to get crypto in. It's like, or we could just take cash. Yeah, I guess that would be the easier way. Oh, well, we could do this and then on layer 2 you could do this and then you could do that, or we could just take cash. Yeah, I guess that would be the easier way. No matter which way you did it, it was almost like you were forcing it into place just to say, aha, we accept crypto. And that you were, the solution didn't present itself. You were forcing the solution in. So you end up coming to the conclusion of, yeah, but here's the thing. Crypto is a solution for a problem we just don't have. And for those of you out there who are 24 to 35, because that's the bigger part of the audience according to YouTube, you may think, well, here's a boomer who's just out of touch. First of all, I'm not a boomer. I'm a Gen X, not a boomer. And I'm not out of touch. I'm probably more financially sophisticated than you are. I probably deal with more financial securities and in more ways than you do. I do business in multiple countries. In fact, you could say I do business globally. I deal all the time in 4 different currencies. I am not unsophisticated. I've moved millions of dollars across borders. So I am not unsophisticated here. And in all of that time, I have always been thankful for that trusted third party. Always. I have them. They have my back. Always I have that there in place. And never have I said, I need a new solution to this. Trust costs money. Okay? Trust, I'm going to write that down. Trust costs money. How do you want to pay for that? You can pay for it with the system. The system has trust built in. You have rules of law. You have contract law. You have courts. And you have good, trusted third parties. You also have fraudsters and scammers in the real world like you have in crypto. You have more in crypto than you have in the real world, but you'll always have criminals. You'll always have criminals. What they decide to use may change over time, but you'll always have criminals. But I have a system, and this is highly leverageable. It is, and it is highly scalable. Right? It is highly scalable. Now, trust costs money with crypto as well. and that is just the sheer amount of electricity that gets used. It's highly inefficient, but the crypto side would say, yeah, but you're spending a lot of money on the system to generate trust anyways, right? So how do you want to pay for your trust? You're going to pay for it anyway. So to argue that, well, you don't need trust with Bitcoin, is, but I want trust. I want all the advantages of trust. I don't want to abandon it. And blockchain was never about we can't trust our third parties, so let's invent something else. Blockchain was, in the end, a computer science puzzle of how could you get to a point where you can have these transactions without the trust of the third party. It wasn't that they were shitting all over the third party. They were saying it would be nice to have a third party, but how would you do it without the third party? So it's not that was finding a solution to trust. It was the elimination of trust, but that has a cost as well. So what do you want to pay for? Again, with everything that I do, and in all the places that I do it, now I guarantee you I'm far more financially sophisticated than you are, and I do a hell of a lot more in the global economy and the global financial system than you. I can pretty much guarantee that, and I have found zero reason why I would ever want to abandon my trusted third party. I have found zero reason why I would want crypto, and in even sitting down and discussing how to involve crypto in your business, to say, well, maybe you can reach out to more people. All we're doing is we're trying to twist ourselves up in a pretzel just to have, looking for a problem that this is a solution for, and we just can't find a problem that this is a solution for. So I think that's way too much of an answer for what you wanted. As far as all this lending out business, once you start lending out, you increase the supply. Even without fractional reserve, let me prove it to you. Let's say you have a company, ABC, and it has 1 million shares. That means you have 1 million long positions, 1 million votes, right? 1 million votes. And you have me that says, I want to short some of these shares, so I borrow shares. I am short 100,000, and I sell the 100,000, and we'll just put other investors over here are long 100,000 shares. You now have net longs of 1.1 million. Net longs of 1.1 million. Gross longs of 1.1 million, net longs of 1 million, because I'm short 100,000 here. But these people feel they own it, and these people feel they own it, right? So you have now, in people's minds, 1.1 million votes. Now I am short here, but I have increased the number of people who are long and who will benefit from being long this coin, these shares. Now, if it were fractional reserve, in other words, I could borrow 100,000 but sell 200,000. That's fractional. Now I'm increasing the count altogether. And since these are not votable shares, there's nobody to stop me. Here, you can only have 1 million votes out of 1.1 million shares. If 1 million votes wanted to vote, I would be called on my short position, and I would have to cover my short position if that were the case. I would have to go buy 100,000 shares and deliver them if they wanted to vote. Bitcoin doesn't vote. So you could, in essence, if you had one central authority, one private organization that controlled a significant amount and lent it all out, you would, in essence, increase the supply of Bitcoin that is in the market. So you would not have 2.1 or 21 million coins. You'd have whatever you want it to be, and as soon as you start with fractional reserve, it's unlimited. So it sounds like Bitcoin is trying very, very hard to be a currency like the US dollar. And if that's the case, let's just use the US dollar. Curious how your move to Costa Rica turned out. That's a big question. Turned out how? It's been a year, I guess. Yep. Expectation versus reality. Uh, well, I don't want to get into my issues with the culture. Appreciate if you could share some insights if it's not too much to ask. Thank you once again. Happy New Year. Any poem upcoming similar to what you shared back in December? Yeah, I have a poetry video releasing later today. The theme is advice. Could you expand further on the term premium and how to play it? I don't know that you can play it. You can agree with it or disagree with it. I think that's about the only thing I can say. How does the triple C returns being so profitable this year? Well, the shrinking of the spread. You shrink a credit spread, you'll increase the price. When you say you are long large cap, plus SPY negative, how much IWM relative to your SPY position are you short? No, I'm not saying that that's what I'm doing. I'm saying there's an alpha setup. I think I think large cap continues to outperform. So long SPY, short IWM. I'm not long SPY. I'm long other things that have a beta component, and some of them are risky, especially the volatility plays. So I'm going to be short IWM because there is a nice correlation between higher beta stocks, riskier stocks, and small cap stocks. If IWM retreats, I make money on the short position, but I'd lose on the long positions. Jamie Dimon's view on U.S. bank regulations. He's expressed some strong concerns. He always has. Yeah. Biggest problem I have with all these overlapping rules is that we are not stepping back and saying, what could we do better to make the system work better? Yeah, I don't see a question in there. You are correct in that the computational difficulty to solve each block will adjust down if mining activity tanks should Bitcoin price drop significantly. So much so that a new block is solved every 10 minutes. Correct. What I don't get is if regardless of the computational resources deployed, a new block is pretty much mandated by the system to be solved every 10 minutes, then why is the network designed to force the energy wasting mining activity at all? That is to get consensus, and only with consensus can you eliminate trust, because it's sort of kind of coded into the system that that if you do it this way, it's difficult. It would be, well, I wouldn't say, what would be a good word to use? It would be near impossible, or not profitable, or infeasible to attempt to hack the system. So you do need that that mechanism in place. You can't just mandate it to happen. Companies currently have floating rate debt. Do you see any reason to interest rate hedge via 1 month SOFR swaps in case rates pivot? Hedge via 1 month SOFR swaps. Would you call that a swap if it's only one contract? A swap is usually fixed for floating over a period of time, or just sit back and ride the curve down, absorb the lower cost of debt. So here's the thing: if they have floating rate debt, I don't see the Fed raising rates. I mean, that would be an admission that they made a very, very bad mistake. I don't see them raising rates. You may think, well, rates may not go any lower, but I don't think they're going to raise rates. So I don't think that I would swap out my floating for fixed at this point. You mentioned that even at 1 cent per Bitcoin, you still have 18.75 Bitcoin hitting the market every hour. Yeah. Wouldn't, at this low price per Bitcoin, miners not be able to afford the energy cost and therefore stop their mining? Pretty much, most of them would stop, but you wouldn't need ASICs anymore. The difficulty adjustment over time would adjust to the point where you could probably get it done with CPUs, and you'd have hobbyists and collectors that still do this. In 10 years, there'll still be Bitcoin. It'll be nothing, but it'll just be hobbyists that have their computer running, and in the background, oh, I mined this much Bitcoin, and praying for the day where it goes back up again. That's what it'll end up as, is just those guys. If the convertible debt arbs are delta, okay, already did that. Purchase applied series before January 15th. Will I get your positions update videos as well? Yes, you will. went through the comments on your response on cost. Can you please include this in the Q&A response? Riot 10Q, cost per Bitcoin 35. Some similar numbers for Mara. Price goes to 100. Won't these companies crash quickly? Yeah, that is the risk of holding a risky investment on your balance sheet. Right? It's the same as if I was holding, Bell at $46. What if it dropped to 33? Well, then I lose. I lose. Yeah. Also, their convertible bonds, if I'm not wrong, was private placement. Yep. I'm sure the person paying these companies in millions are much more intelligent than any retail investor and have a team of CFAs banking advising them. Yeah. What am I missing? Well, they're not in it for the bond, and they're not in it for the shares. They're in it for the volatility. So they'll issue a convertible bond. They'll buy a convertible bond. Let's say they buy $1 billion of a convertible bond, and it has you're long a bond at that point, and you're long a call option, and that call option will have a delta, and let's say the delta is 0.4. They will then short $400,000 of the company stock. So they have $1 billion. They short 400,000, and they'll borrow 600,000 from somewhere else. Just ignore the phone ringing in the background there. It's probably just another phone scam. That's all that ever happens on my iPhone. I don't even say I have a phone. I have a mobile device that has a phone feature for scammers to get in touch with me. I just don't get phone calls. I get texts. Who gets a phone call anymore? Whenever I hear the phone ring, I think, the scammers just haven't gotten into the text game yet. Anyways, they short 400,000 if it has a delta of 0.4. And what they want is they want the stock to do this. Because as the price of the stock rises, this delta will rise to 0.5. It'll rise to 0.6. That means they'll short 500,000. Then they'll short 600,000. And then they want it to fall back to 0.5 and back to 0.4 so that when as the price rose and they short 600,000, the price drops, they'll cover the $100,000 here, make that profit. And as it drops to 0.4, remember they sold more here, they'll cover this, they'll make that. And then they want to go back up so they could short more, so it comes back down, they make their money. Then they want to go back up so they short more, then it comes down and they cover their short position. And that's what they want, volatility. They really don't want the stock. They really don't want the stock at all. They just want the volatility. So they're there for the volatility. If you're sitting at a table playing poker and you can't figure out who the sucker is, it's you, right? So if you're a shareholder here with these convertible bonds in place, and usually when you have these convertible bonds, the company has an at-the-market offering, which means they can sell shares during the course of the day to investors so that they can ensure this volatility. So if the price goes too much in one direction, they can then push the price down by issuing shares. And then the price goes back up, then they can push the price down by issuing shares. So this is a mechanism by which the issuing company can continue to keep the volatility by selling into rallies. So if you're an investor, you're not playing the right game. You need to be trading the same way the convertible bond holders are trading. That's what you're missing. I think you got it backwards. Russia previously did allow mining. Now they banned it. They banned it in 10 areas where electricity is expensive. For Bitcoin miners, that's nothing. That is like banning me from having sex with Jennifer Lopez. It's like that doesn't change anything in my life because I have zero chance of that happening, right? So if you have a very high electricity cost region, a miner is not going to set up there anyways. So go ahead and ban them from setting up in a high cost region. The miner would just say, I wasn't going there anyways. Good, because you can't. Well, I wasn't. Good, because you can't. I mean, it would be one of those sorts of things, right? So there are municipalities in North America that have banned Bitcoin mining, but the Bitcoin miners would answer back and say, you weren't even on our list anyways, not with your cost of energy, not with your cost of electricity. You weren't even on our list anyways. You need to get under like 3 cents a kilowatt hour for this to make sense. And the lower you can go, the better. But you find places like what's Costa Rica? Even their off time is like 6.5 cents a kilowatt hour. You would never set up a mining operation there because you could never afford it. You could never the electricity would. So even if that country banned Bitcoin mining, the Bitcoin miners would say, "So what? You banned something I wouldn't do. So go ahead and ban it." I mean, it's like a ban on me from doing cocaine. It's like, well, that's fine. I don't do cocaine. So what have you done? You've done nothing other than ban what I've already put a self-imposed ban on. So yeah, they identified 10 regions, but the regions they identified were such that the electricity would never have, or the cost of the energy would never have allowed them to be profitable there anyways. Explain how to go about thinking of an investment theme. What news source would you follow to get the idea? I think I've already answered that earlier. It's more of a, it's experience and intuition over time. And even with that, you're not always right. You're not always right. No one has a 100% track record in this industry. Take the best of the best, and they make mistakes. That's the nature of predicting the future. In the applied level, you talk about how small caps tend to outperform large caps during a boom. Yeah, keep in mind what we're saying here. Tend. This is probabilistic. Nothing in any social system is deterministic. Every statement you make is probabilistic, which means it has a range of possibilities, right? If sentiment is bullish following the election, why do you expect large caps to continue to dominate? Yes, small caps tend to outperform during a boom. You're not really during a boom, usually during the initial recovery coming out of a recession. Tend to. That doesn't mean they always outperform. I just seem to think that we're in a period of technology right now where the benefits are going to accrue to the larger companies. When you have diminishing returns to scale, there's nothing stopping you from being a bigger and bigger and bigger and bigger company all the time, which is what we have. It's hard to compete against those big companies, especially in AI where you need large data sets. Small companies typically aren't going to have them. And they're not going to have the advantage of the low cost of capital that large companies have. In order to price options, is the 3-month or 1-month SOFR forward curve used? Neither. When you're pricing options, these are all spot rates, not forward rates, spot rates, because let's put a timeline. Let's say you're pricing out 1-month options. That's from today. A forward rate is a rate that starts here and ends here, right? So you'd need some kind of forward rate. But if it's from today to a year from now, well, that is a spot rate that we can observe today. It is from today, ending 1 year from now. So it wouldn't be forward curves, they are spot curves. Considering the rate dynamics in treasury yields and Fed cuts anticipated to come more slowly, along with your thesis on small caps, what are your views on private credit? None. I have no views on private credit. Do you still see Mexican Indian equities as a good investment thesis? I think the weaker the peso gets, the more interesting the Mexican market gets, for the simple reason that in your own currency, it becomes a very cheap country to invest in. India still is, the U.S. is the most overvalued market on the planet, period. And if we're looking at forward earnings, the U.S. is the most expensive market on the planet. And with a strong U.S. dollar in every other currency, it is a super expensive market. I don't see how it continues. I don't see where the money's going to flow on that one. I think India, the next 10 years for India are what, go back to 2002, 2003, and think if you could have invested in China at that time, or even 1999. I think that's where India is now. It's India's decade to lose, put it that way. What are some ways retail investors can profit from the increase in volatility without getting into really risky territory? Well, volatility is risk, right? If volatility in deal making is coming back, do you think long XLF and short puts on XLF is a good play? Yeah, I mean, no, not a bad play. I don't know if I'd call it a good play. You can profit from volatility. You're now no longer thinking about the price any longer, the price of a stock, but you're thinking about the rate of change in the price of a stock. That's a hard question to answer. Saying without getting into really risky territory. MSTR, IBIT, yeah, that's really risky because it's very high volatility. But there are ways to play volatility if you know that you're playing volatility. It's a hard one to answer. What are your thoughts on selling options in a higher vol market? Well, that is what you would do. You would be a seller, not a buyer. Obviously, higher premiums in general, but also higher risk comes with that. True. Can retail use option selling to take advantage of additional vol? Yeah, but I'd say the more inexperienced you are and the smaller your account, the more you'd kind of want to avoid doing that. Rate of Bitcoin hitting the market will remain constant due to difficulties, maybe constant hash rate, constant block rate. There is halving policy, meaning new supply created for each block solved will decrease over the long term every 4 years. So while supply is almost constant no matter what the price is, in the short term, the long-term supply still remains finite. Same with gold. Could this finite supply be a price support for Bitcoin in the longer term? Why? Again, I'm going to use an example. Let's say I build 10 planes. But the market doesn't want them. And I say, but there's only 10. It's limited supply. I've only built 10. Yeah, but the market doesn't want it. It's not the supply, the limited supply, that will ultimately determine what the price of this thing is. Right now, that's part of the narrative, supporting the price. It's part of the narrative, it's limited. But so is gold. Anything you can say about Bitcoin, you can say about gold. You can say, well, there are 19.6 coins minted and there'll only be 21 million. Well, gold, there's 212,000 ounces and the estimates are that there are 212,000 tons of gold that have been mined since the dawn of time, and the estimates are there's only about 50,000 left in reserves. Well, look at that. Limited supply. At some point, it'll be over. At some point, it'll be done, right? But this is used in jewelry. This has an industrial use as well. This is held by central banks. These are zeros and ones, right? These are zeros and ones that are, well, for lack of a better word, imaginary. What value does it have? Outside of zeros and ones, you can't bring it into the real world. You can't do anything. You can only hope it has value by somebody offering to give you more. Just because it's limited doesn't mean it's worth anything. It just means it's limited. A limited supply of nothing is still a limited supply, right? So if it were zero, it would still be a limited supply. It has value only to the extent that it is valued. It has no other use at all. I don't agree with the limited supply argument. And if you think about the evolution, if you're a stronger believer in Bitcoin, you think about the evolution, saying, but there'll be a whole vibrant borrowing and lending market. Well, then you can't use this argument. As soon as you bring that in, you can't use that argument. You can say the same thing for gold when you talk about halving. You say, well, every 4 years the amount that's mined gets halved. Well, if you look over time at the yield per ton, for gold, this is the amount of grams you get out per ton. That has been decreasing over time. The grams per ton have been decreasing over time. Well, that's the same as a halving event, right? Anything you can say about Bitcoin, you can say about gold, and gold is real. I can do all sorts of things with gold that I cannot do with these imaginary zeros and ones. I can't make a wedding ring out of that. I can't make watches out of that. I can't make jewelry out of that. And I know the vanity of people. They want jewelry. So right away, I know there's going to be a need for about 50% to 55% of the gold that comes out of the ground is going to end up in jewelry. I know that. But how do I put those zeros and ones into a pendant? How do I turn that into a ring? All I can do is hope that somebody gives me some fiat currency for those zeros and ones that I can then go buy some of that jewelry with. Well, am I not buying gold at that point? Right? Where did I leave off? Do you think another Plaza Accord could be an option to weaken the U.S.? I find I think it's going to be challenging to demand to other countries that the U.S. dollar keeps its reserve status, but then at the same time try to devalue it. Either the U.S. dollar has reserve status and it's going to have reserve status no matter what, and then you can weaken it, or if you have to demand that it has to have reserve status, you're going to have to support it. Is the U.S. dollar in the position where the administration can say, we can do whatever the hell we want, the world has no choice but to hold U.S. dollars? They got no choice. Now, if the world has no choice, then you are free to devalue your currency. But if the world has a choice and you want them to take your choice, you're sort of constrained in what you can do, because you can't force them and demand that they hold it and then devalue the currency at the same time. You can't win on every single point and expect the other side to simply just lose. And if they don't lose graciously, you're going to punch them in the face again. You can't expect that to happen. So I think he's going to get a wake-up call in all the things he's promised. Some of the things he's promised are counter to other things. You can't weaken the currency to help your trade deficit. At the same time, you're going to put up tariffs on other people coming in, other things coming into the country, and expect no tariffs on your stuff leaving the country. Expect everyone to hold the U.S. dollar but devalue the U.S. dollar at the same time. You got to pick your priorities. You could do it before. With the original Plaza Accord, because you were in a position where the world really has no choice. The world really has no choice. Well, now they have choice, or they are thinking of creating a choice. Did you change your view on gold? Nope. Any view on nuclear and quantum computing? Nope. No views on any of those. Decrease in the spread. I've heard that the demand for U.S. denominated fixed income instruments has been high in the euro dollar market. That's a money market. Just to be clear, a euro dollar is a dollar invested or dollar placed in a bank outside the U.S. banking system. So it's outside of U.S. regulation, but it's a U.S. dollar deposit outside the U.S. Perhaps the strength of the U.S. has forced the eurodollar market or other sovereign nations to dump or not purchase as much as before. This would have to come from the bank then, right? So I'm a bank that is accepting U.S. dollar deposits. I'm not part of the U.S. banking system. Actually, we'll do it this way. So I'm accepting U.S. dollar deposits, and somebody at some point is going to come and they're going to want their U.S. dollars back. So I have to hold it in U.S. dollars. So I'm more likely to hold it in T-bills. because I can't take any risk with this unless you're thinking that there is some kind of maturity conversion where they are taking risk and they're holding bonds, they're holding U.S. bonds. Because I may be a euro-based bank and I'm holding U.S. dollars, or I could be a Swiss bank, or I could be a Japanese bank holding U.S. dollars as a deposit. That is a euro-dollar deposit. I'm clearly not buying I'm clearly not buying euro-based bonds or yen-based bonds, because I'd have to convert the USD, and the depositor is going to want their USD back. So I have to hold US dollar denominated something. I'm more likely to hold T-bills because I don't want duration. Duration equals 0. I don't want duration because I don't want price risk. And once you start introducing corporate bonds in here, now I'm going to have duration risk and I'm going to have credit risk at the same time. And if they come to get their US dollars, I have to deliver their US dollars. Nice thing is, because there's a lack of regulation here in what needs to be done, you can have a tighter spread between what you pay and what you get, only because you don't have the cost of all that regulation. Perhaps the strength of the U.S. has forced the euro-dollar market to dump or not purchase. Let me think about how that would work. The strength of the U.S. dollar, let's say I'm here. I would say, okay, you know what I want to do? I want to take these U.S. dollars and I want to convert it to my currency because it's a good place to be. Then the bank would have to dump off this T-bill, deliver my U.S. dollars. I would get yen or euro. I'd deposit the yen or euro, and then the bank would then place that yen or euro into either loans or securities denominated in yen or euro. But I think that would be concentrated in the T-bill market, not in the capital market, but in the money market. I don't know. I don't know enough about that market to make that guess, but just thinking it through of what a euro dollar deposit is, it would seem odd to me that it would find its way into the long end of the curve. I have applied series but haven't picked up positions. In which video? Positions is in portfolio construction in that module. S&P 500 valuation, is historical valuation relevant? I've already made this argument that it might not be. The tech sector was a much smaller part of the index. Yeah, I've made the argument before that it might not be relevant anymore. Thoughts on MMT? I've given my thoughts on that lots of times. I think it's just pure nonsense. Based on some things you say, you sound like someone who follows MMT. What? Okay, so you don't understand what MMT is. MMT is kind of like wokeism. You need a simple-minded audience to believe this shit. I don't know any serious academic that would accept this stuff. They're fringe academics, much like there's a couple of fringe academics who believe in Bigfoot, but they're fringe academics, right? Other than fringe academics looking for attention, I don't think anyone believes this shit. I don't know any central banker who actually thinks this stuff has any value whatsoever. Modern monetary theory is bullshit. It's based on a lot of misinformation as well. I can't get through more than 5 minutes of a presentation on this before I say, okay, that's enough of that. Because the statements that are made are meant for an uninformed group of people. That if you knew nothing about monetary policy, you would think, okay, well, yeah, okay, that makes sense. But it's all bullshit. It's all just misinformation. That anybody who's informed enough listens to this and says, okay, that's enough of that. If you say that I sound like someone who follows MMT, you don't know what MMT is at all. Because if you knew what MMT was, you wouldn't say that I sound like that at all. Now, with Trump back as president, Bill Ackman is talking up Fannie and Freddie. Something about restructuring its ownership to unlock value. Seems complicated as the Treasury is also a large beneficiary. Um, yeah, but we have the same problem in Ontario, right? LCBO is owned by the government of Ontario. If you want to buy rum or vodka or whatever, you got to go to a government store to do it. Do you want government in private business? And the government has a monopoly on it, saying nobody else can sell hard liquor. Only we can sell it. Would you not have a much more vibrant economy and better access and better selection and a higher tax base if you privatized it? You could say, well, the government gets a lot of money from it, but they'd still get a lot of money from it, just in a different way. So they're a large beneficiary of it. But could it be run more efficiently outside of the conservatorship? Could there be greater profitability, in which case the tax base would be higher? You'd also introduce, probably, if you unlock more value, you'd have the price go up, you'd have capital gains, which would then produce capital gains taxes, right? They used to be private. It was the 2008, the housing crisis, which created a whole problem there, and they had to step in, or things could have gotten a lot worse. So maybe they were part of GM as well. The government did own, when they restructured GM, they did own shares of that, and they got out of that. Maybe it's time for them to get out of private business. You want your government to be big, or you want it to be small? Do you want it involved in private business, or not? I mean, you could say, but they get revenue from it. Well, then why don't they buy Walmart? Why doesn't the government buy every publicly traded company in the S&P 500? Because they're all profitable. Now the government would get all that money. But how efficiently would all those companies be run if the government ran it? Maybe you don't want the government involved in private business, right? Get us another Koifin discount. I could, but why? I don't know why. I don't know what is there that you would. Well, they actually have good access to historical data. If you're doing any research on a company, they're rather inexpensive. But what I showed you in the market outlook when I went to Koifin, that's the free side. You don't need a subscription for that. 20 years old today, studying finance. What would you do? What kind of job would you pursue right after your studies? Well, I don't know if I'd say what kind of job I would pursue. Oftentimes it's what jobs are available for graduates, not what job would you like to pursue. Some jobs are simply not available to graduates. So you can decide on two broad sides of the finance market. One side is analysis. The other side is asset management. It's asset management is not really an entry-level position. So usually it's something in analysis that may lead to asset management, analysis on the buy side perhaps. Also, would you say it is smart to do CFA as early as possible in the career stage? I would say, based on a balance of a life balance, and I'm speaking again probabilistically here, as you get older, you tend to take on more responsibilities, whether it be marriage, family, things like that, but you tend to take on more responsibilities, which leaves you less time and more pressure. That while you're young and still in that student mindset, it might be worth it to do it then. However, I don't know that I would race through level 1, 2, and 3 without a job or without real world experience, because a lot of things at level 3 won't make a lot of sense to you without some real world experience behind you. That I would be looking at CFA as, let's get out of university, let's get a job, let's get settled in that job, so that I'm not learning too many things at the same time, because there'll be a ramp up period to get onto that job. After about a year in the job, let's start the CFA. That's the sort of the progression that I would take, because the content will be much more relevant if you have some real world experience. If the Fed has lowered rates in recent months, but the long-term yield curve has risen, does this outcome align with the Fed's dual mandate of price stability and maximum employment? I seem to think it challenges the maximum employment, as I've said, because so much of consumer loans and consumer debt is priced off capital market rates, not money market rates. So I seem to think that it is tightening financial conditions. Could the steepening reflect market optimism about growth? It could. But I think less so about growth. Or does it signal concerns about inflation or fiscal imbalances? I think that's the bigger concern. If you listen to the narrative, it's not like everyone's saying, oh my God, growth, yields are too low, oh my God, growth. It's about inflation and fiscal imbalances. How should the Fed interpret and respond to this dynamic to ensure its policies remain effective? This may accelerate the conversation about balance sheet runoff, maybe ending it by the end of the first quarter, beginning of second quarter instead of the middle of the year. It may accelerate that. It may accelerate the desire to sell MBS and buy U.S. Treasuries, because they do want to reduce the roughly $2 trillion they have in MBS and replace it with Treasuries. That could give them some excuse to yield curve control on the longer end of the curve without increasing their balance sheet. They'd take a loss on selling MBS, but they'd be buying U.S. Treasuries at a lower price, so that by the time it matures, they'd make their money back that way. They're just getting out of one undervalued security to get into another undervalued security. Nothing wrong with that. They could do that, and all of that would be without increasing the size of the balance sheet. They could get that done, because they have said they do want to be out of MBS in 2 years, and this was like a year ago. That could force them to accelerate those plans. Okay. Vance was making a point in the past about the dollar being strong and how it punishes the U.S. economy. I've already spoken on that. Could one say that the more stable the price of Bitcoin, the more easier we can price goods in Bitcoin? Again, why? We already have dollars to do that with. I don't understand why we're doing this thing with a potentially deflationary. If we think about it as a currency, it would be bad. It would be deflationary. I don't know why we'd want to do that. So, you can look at Bitcoin and you can look at US dollars, and you could say, well, this is inflationary, but this is deflationary. Which one do you want? Do you want to live in an inflationary world or a deflationary world? This one is very bad. This one here requires you to work. This one here requires work for you to beat inflation. This one is just very bad. Period. So which one do you want? There are trade-offs. Bitcoin gets rid of the inflation. Yeah, but you get deflation. So, pick your poison. There is no outcome that has nothing but upside. I really encourage you, and maybe I should put something in the applied level on this, but I really encourage you in the economics literature to look at complexity theory, right? Because it is the only thing I think that truly describes a social strategic system, and an economy is a social system. It is a complex system. There is no solution for a complex system. There are solutions for complicated problems, but not for complex problems. When you have complex problems, you only have trade-offs, right? You only have trade-offs. And once you understand complexity and you start thinking about Bitcoin in terms of complexity, you can say, okay, well, you have these things. What are your trade-offs? And ask yourself, are the trade-offs better than what you're getting? So for what you're gaining, are they better than what you're losing? Because you are losing something. There's always trade-offs. That's how we determine whether a policy is effective or whether an action would be effective, is if the benefits outweigh the negatives. There's never just benefits. There's never, nothing can go wrong, everything will go right, and this thing will only go up. Get that out of your head. That's just bullshit. That's fantasy that's being sold to you by someone. Take some time and investigate complexity theory, and look at especially decision making. Decision making under complexity, because finance is a lot of decision making under uncertainty, right? Look at decision making under complexity. It is different. Let's see. I think that's it, right? Oh, we're almost done. Okay, a couple more here. There was a long one here. Let me get to that one. Could a crash in MicroStrategy stock significantly impact Bitcoin's price? If MicroStrategy can't issue more shares to pay back that debt, and it has to pay back that debt, it would have to sell Bitcoin to do it. Yeah. How do you like comparison? How do you like comparison the current dominance of mega cap tech stock? Oh, how would you compare, I guess is what you're saying, to the Nifty 50 era, the 60s, 70s? Both periods featured companies with substantial earnings and perceived market well, the big difference from the 60s, one of the companies in the 50s were looking to get bigger through diversification. They were diversified companies. So you had company ABC, which would be in a whole bunch of different industries, right? So diversification was the big thing from like the mid 60s, late 60s, those big companies. Huge diversified companies like GE would have been in 12 different businesses at the time, right? You don't really have that today. You have a lot of specialization and a lot of focus in particular businesses. So something like Netflix, we know exactly what it does. It's just big. Something like Apple, we know exactly what it does. It's just big. So Apple is not trying to be in tech. It's not trying to be in retail. It's not trying to be in aerospace. It's not trying to be in mining. It's not trying to be in all of those different things. It's one thing and it's big. Back here you had the idea of decreasing returns to scale. So if I can only be so big here, why not be in a whole bunch of different industries where I can be big in a whole bunch of different industries, and then we can manage it from the top. Now we have the concept of decreasing returns to scale, which means there is no limit to the size I can be in my technological space, so why don't I just get bigger and bigger and bigger in doing what I'm doing? So it's a different type of size today than it was in the 60s. You could argue that these weren't big companies. They were simply portfolios of average size companies. And the portfolio of average size companies made it a big company. Whereas today they truly are big companies. Past 10 to 15 years, U.S. yields have often been higher than those in major European economies, primarily due to ECB's lower interest rate policies. Past 10 or 15 years, really? You had the Fed pretty much at zero. We had the 10-year under 1% for a while. Germany's always been quite low. I'll take your word for it. I don't know that that's true or not. 10, 15 years. Other factors at play. I would have to say other factors at play because the Federal Reserve had rates low for a very long period of time. It could be the nature of the market. The U.S. is more of a market financial. When we're talking about financially, if we look at balance sheets, more equity than debt. Whereas it's more of a market-based financial system, meaning you go to market to raise your debt, you go to market to raise your equity. Whereas in Europe, it's more of a banking financial system where you go to the banks to raise your money. So that could lead to different valuations of debt in Europe versus in the U.S. I believe European countries are companies probably more leveraged than American companies. simply because of the heavier reliance on the banking sector for financing as opposed to the public markets. That could be a reason. RRP and reserves, where TGA is in there, the TGA is not part of reserves. They're not available for the banking system. It's just a bank account for the Treasury. I agree. Over leveraged companies mismanaging Bitcoin-backed debt risk defaulting when Bitcoin prices drop. Bondholders even Bitcoin as collateral may unload it on the market. They will, triggering a cascade of forced selling and further price declines. Yep. More numbers coming soon. I don't know what that means. Can I push back on your Trump take? Is Trump really that smart or powerful as to manipulate markets downwards? And the other one is the same thing. I didn't say, hey, Trump is doing this. I said, I got a sneaking suspicion. A sneaking suspicion is not an accusation. It's just, if you look at the way Trump is, it's like, I just got a sneaking suspicion. Like, and to think that, if you think that he hasn't got the power to do that, one tweet, if Trump wanted to, he can crash the market tomorrow with a tweet. He can. Or he can make the market, surge ahead with a tweet. All he has to say is he's going to do something really ridiculous. He can do it. He won the election, and look what happened in the market. Look what happened to Bitcoin. Everything went up because, and then his godlike status increased every day after the election of how wonderful, how absolutely wonderful everything was going to be. I was saying at the time, the equity market is getting all the good news and the bond market's getting all the bad news. Anything bad, well, that belongs to the bond market. And the equity market was getting nothing but the good news, right? He could tweet something tomorrow. He could say, I really don't see why the U.S. is even holding a single ounce of gold. He could just tweet that. What do you think would happen to the price of gold tomorrow? Right? I mean, all he has to do is tweet that. That's how much power he has right now. So he does have power to do whatever he wants. I just say I have a sneaking suspicion that he would love to see the market crash before he takes office, so that all the recovery belongs to him. And if it doesn't recover, well, the market crashed under Biden, not me. It would give him the cover to be able to claim all the success that belongs to him, and all the failure belongs to the other guy. I think what he probably would not want is to take over a market at all-time highs, to see it go up for 3 months and then crash sometime in the summer under him. How are you going to blame the other guy on that? Right? I mean, I'm sure he'll find a way to blame somebody else for it. He'll blame Powell. He'll blame the Treasury. He'll blame the Clintons. He'll blame somebody for it. But it's a lot easier if it does it now. So if the market is dropping, my suspicion is that he'd probably do very little to give it any encouragement. Why? Why not let it drop, right? If yields are rising on treasuries, my thinking is, why would he give the market any encouragement that they're going to fix the problem? Why give it any encouragement? Let it happen. So I'm not saying he's engineering this 3D chess game. I'm saying that I don't see why he would be against this happening right now. That's just my sneaky suspicion that I have. That doesn't mean I'm accusing him of doing it and orchestrating this big conspiracy. Just that I got a sneaking suspicion that he doesn't mind what's going on right now. And that's it.